I can see that only 6 people have joined, so we'll just wait for another 5 to 10 minutes for everybody else to join before we start. Okay, we'll start with whoever we have now. Hi, everyone. So in today's session, we're basically going to go through, So we're going to go through certain Excel formulas which would help us in financial modeling. Okay, I am not sure if you guys have had the chance to go through the sheet. Please keep responding on the chat, probably would be easier for me, but anyhow. So these formulas are going to help you in the financial modeling to make your model more consistent, to have the same formula across the entire model, and to calculate certain financial aspects using these formulas. So we'll start with the date and month formulas. Okay, so we have 4 formulas here. One is E date, EO month, which is end of month. Then there is year fraction, and then there is days 360. Before that, just the basics. There's this formula bar. If you and any time in Excel, when you don't know like what is the syntax of the formula or what is the formula used for, you just need to do this, and you need to write like partially whatever is the formula, and you will get to see like what is the function of the formula. It will give you the prompt. Like when we write E date, it says that it returns the serial number of the date, that is the indicated number of months before or after the start date. And when you put this entire formula, then it will tell you what is the syntax. So like you have to give a start date and you have to give the number of months you want from the start date. So suppose you have to calculate that suppose you are at right now we are at 19 December, and you have to calculate what the date would be after 1.5 months or 1 month, 2.5 months, or whatever the case be. So you can use this formula and calculate this. So here we want to these are the certain dates which are here: 1st April 14, 31st March 14, and we want to calculate what would be the exact date after 12 months. So we put E date, we put the start date, which is 1st April 14, that's why C6, and then we put 12 months, so this is B8. In case I change, so now this formula has been applied consistently to all the columns. So in case I change this to 5, suppose like during the model, let's say that we were using this to calculate our repayment dates for a loan. So now instead of 12 months, we want to know 5. So instead of going into each formula and changing the 12, now all we need to do is change our assumption here as 5, and this will automatically change. So end of date and end of month are similar sort of formula, but what end of date does is it gives us the exact date after 12 months, and end of month will give you the end of month of that date. So suppose if you are at 1st April 14, your exact date after 12 months would be 1st April 15, but the end of month would be 30th April 15. So it's a similar formula, but it gives you the last date of the month. So suppose here I change my date to 10th April 14th. So my end of date after 12 months would be 10th April 15, but end of month would be 30th April 15. So yeah, these two formulas. Let's now we do year fraction. So a lot of times we want to calculate the number of years in between two dates. So like suppose we have to calculate how many number of years are between 1st April 14 to 1st April 16, then it is relatively simpler because we have the exact date to date. So you say 2 years, but that's not always the case in the financial modeling. Maybe you have to calculate between 1st April 14 to 20th September 15, or 30th November 18, anything. So basically this year helps you calculate, like it gives you the time span between in 2 days in terms of years. So year fraction, so you calculate the start date again. So like if you want to check the syntax of this formula, you write year fraction, and it says you have to give the start date and you have to give the end date. So the start date is 1st April 14 and end date is 25th September 15. So let's say again, like suppose you were calculating that in how many years like my loan would be repaid. So suppose the bank tells you that in how many installments or years. So if the bank, like suppose you're with the drawing amount of your loan is started on 1st April 14, and the bank says that it wants like for you to pay the loan by 25th September 15. It is so the base 360 beginning date and the end date, but it takes the formula to have 360 days, which is 12 months of 30 days each, and that's how it calculates the number of days. Any issues or questions so far?
Hello, ma'am. Please,
Yep.
can you please explain the year fraction again?
Okay. So year fraction basically tells us, let's look at the formula first. So if you put year fraction here, it tells us it returns the year fraction representing the number of whole days between start date and end date. So suppose if somebody tells you how many years are there in between 1st April 2014 to 1st April 2016. So you can easily say 2 years, right? 1st April 14 to 15, then 15 to 16. But if the same question is asked that how many years are there in between 1st April 14 to 29th September 15. So then it's difficult to calculate like that. So then this formula helps us. It basically tells us how many years are there in between. So like if we expand the decimals, it's 1.48 exactly. So if you calculate manually between 1st April 14 and 25th September 15, how many years would you have? So 1st April 14 to 1st April 15 would be 1 year. And then after that, you have May, June, July, August, September. So 5 months and 20 days, 25 days more. So that it has converted into terms of years, and it basically tells you that between these 2 days, you have 1.48 years. So that's exactly what the formula does.
Okay. Okay. Thank you.
Okay. Any other questions in this? Okay, so all the syntax of all these formulas, basically you have to have a start date, and then you have to have the number of period in case of end of date and end of month, and in case of year, fraction, and days 360, you have to have an end date. So yeah, that's about these two. Now the next formula which we'll be seeing is net present value, which is NPV. So there are two formulas which we'll see here. One is XNPV and one is NPV. So net present value basically, in layman term, it is like suppose you invest 1,000 rupees today, and that 1,000 rupees is going to give you certain return over the next 5 years. So what would be the present value of those 5 cash inflows over the 5 years? Because the rate of money keeps changing over the years given the discounting rate. So what would be the present value of that money which you are going to get over the next 5 years? So that we calculate using the NPV or XNPV. So it's basically giving you the net present value for a scheduled cash flows. And why do we have two formulas? Like why do we have XNPV and why do we have NPV? So these two formulas work in two different scenarios. NPV works the best if you have periodic cash flows, like your cash flows is every year, like starting from 17, like in this, if you have like 18, 19, 20, 21, every year if you have your cash flows, then NPV works really well. But XNPV works well when the series of cash flow is not periodic. Like suppose one is in March, then the other one is in September mid-year, then the third one is again after 7 months or 8 months, then XNPV works the best. So let's look at this example here. So we kind of investing 150 in March 18, and then over the years we have these cash inflow. Our discounting rate is 15%, and year is 1, 2, 3, 4 accordingly. So our discounting factor, so like the second year, our money would be discounted by, like it would become 0.76, then further by 15%, further by 15%, like that. So our present value is 115 to 0.87. So now there are two different things. Either like we can start discounting. So currently we are sitting at 2017, and we are saying that we'll start investing our money at March 18. Okay, so we can start discounting our money in the first year itself, because it is actually the second year from where we are sitting. Or we could also look at it like we don't want to discount the first year because that is the year we invest, and we only discount from second year onwards. So there are two ways of doing this. In this example, we've discounted the cash investment or cash outflow as well. And then, so net present value is the sum of all these, which is 4.7. So now, instead of doing this entire thing manually like this, like every year, we can use the NPV and XNPV formula. So how will you use the XNPV formula? Is this, so let's use the NPV first. So here, if you see, it's March 18, March 19. So our cash flow is periodic every year. So NPV will work the best here. So you've selected all your cash flows and you've selected the discounting rate. So before that, if we write NPV and we see the syntax, it says that you have to select the rate, which is the discounting rate 15% here, and then you have to select the cash flows. So value 1, 2, 3, 4, how many ever periods you have. So we've done NPV B9, which is our discounting rate, and then we've selected all our cash flows. So it gives us 4.7. And when we manually calculated, it was 4.7. So in this case, because this is periodic, our NPV is matching completely. If you used the XNPV here, it wouldn't match. So now the one difference was that XNPV gives us a better result when our cash flow is not periodic. The other thing is that XNPV uses the second method of calculation. It does not discount the first period. Like, because our first outflow is in this period, it takes the discounting factor as 1. It starts discounting from the second year onwards of the outflow. So that's why there's a variance in what we calculated manually and what this formula calculates. Now, so here we saw that our cash flow was annually. Now, if we see, like, this is an example of our cash flow not being annual like that. So here, the same example, the discounting factor, etc., we've done this manually, and then we calculate the same using XNPV and NPV. So if you calculate it manually here, the first thing, see, this is the main difference it comes here. XNPV is not discounting the cash outflow in the first year, and NPV is discounting the cash outflow in the first year. Look at this now. This is 30th June 17, October 17, then Jan 18. There is no fixed period between the cash flows. So now if we use the NPV formula, it gives us 78.9 NPV. You manually calculate it, it is 55.3. So that means the NPV formula has stopped working because the cash flow is not periodic. If you look at X NPV, it gives you 55.2, which is actually equal to what you would have manually calculated without the help of formula. So just to revise this again, X NPV and NPV, they are used to calculate the net present value of a scheduled cash flow over the years. X NPV does not discount the first year of the cash outflow. It discounts from the second year onwards when we start getting the cash inflow. And then NPV discounts the first year as well, because the time period which we are sitting at and the time period when the cash outflow is happening is a different year. So it discounts the first year also. Secondly, XNPV works better where the cash flow is not periodic. So it can be an interval of 3 months, 4 months, 5 months, anything. NPV works better when the cash flow is periodic. Any questions so far on NPV?
No.
Okay. So moving on to IRR, like we have XNPV and NPV, similarly, we have IRR and XIRR. So now what NPV does is it gives you the net present value. What IRR does is it gives you the discounting rate at which your net present value would be 0. So your outflow is equal to inflow. So it would give you at what discounting rate you would be at a 0 NPV. Is again the same thing, that XIRR is better used when the cash flow is not periodic, and IRR is used when the cash flow is periodic. So let's look at the syntax of this formula. If we do IRR, it is values and guess, it says. So values means the value of cash flow. So this is we give our value of cash flow, and then we give the dates of these cash flows. And in case of, so for XIRR, we need to give the dates because it's not necessary that the cash flow would be periodic or not periodic. So it takes into account both the things, the dates of the inflow outflow and the amount of the inflow outflow. IRR, we only give the amount because IRR assumes that the cash flow is periodic. So similarly, if we look here at this particular one where the formula is erratic. So our outflow inflow has remained the same. Like if you look at this example, 150, 20, 35, 45, and the first example, 150, 20, 35, 45. But the dates here, we got these outflows every year. So our discounting rate was 16%. Now we're getting these outflows in 2017, 18, like different period. IRR still calculates the discounting rate as 16%, but XIRR gives you the real rate, which is 43%, by taking the dates also in account, like the period of the cash flow also in account. Any questions?
Sorry, ma'am, not clear exactly.
Okay. Okay, I'll do this again then. So IRR is basically interest rate of return. Are we clear on the NPV bit?
Yes, yes, it is clear.
Okay, so NPV, we did X NPV and NPV. So X NPV was useful when the cash flows weren't periodic, like at periodic interval of 1 year or something. Similarly, X IRR we use when the cash flows aren't periodic. And like NPV we use when the cash flows are periodic. Similarly, IRR function we use when the cash flows are periodic. Now, what is the function? NPV gives the present value of the cash outflows or inflows as at date. What at a certain discounting rate. What IRR does it helps you calculate the discounting rate at which your net present value will be zero.
Okay.
Okay.
Yeah.
So
Here we have to find the rate.
sorry.
Here we have to find the rate.
We have to find the rate, yes. So
Yeah.
here, let's go back to the NPV example. Here it says that net present value is 55.3. So we say our net present value is 55.3, our discount rate 18%. If somebody asks the question that at what rate will our net present value be zero?
Okay.
So that is when we use IRR. So here, if you look at this example, the 50, 150, 20, 35, 45, our cash flows is the same as this example. So here we were using 18% and we were at an NPV of 55.3. And here we are saying that if we wanted an NPV of 0, our discount rate should have been 16%. And to calculate this, we use the formula of IRR or XIRR, which is internal rate of return.
Right.
Okay.
Yeah, thank you.
Okay. Now this is a data table. This is mainly used for simulations. Like suppose you have one table which says that at a discount rate of 15%, you will get an NPV of, here in the example, like it says that you'll get an NPV of 231.2. This saying that at like there are 5 discount rates and you want to see that at each discount rate, how much, what would be the NPV, like 15%, 16%, 18%. So you want a table like that in which you say that at like the discount rate is variable, it will keep changing, and at each discount rate, you want to calculate what is the NPV. And you don't want to, keep calculating this table again and again, that you copy this table, make another table, and which you change the discount rate. You don't want to do that. You've done this calculation once and you want to keep changing the discount rate and keep saying, how will your net present value change with the change in discount rate. So now here we have our cash flows, and then we have our terminal growth rate, discount rate, our discounting period, and this is like the discounting factor according to the discount rate, and this is our present value. Before we move on to the data table, which we have to discuss here, first we'll do the terminal value. So now what happens, so today we're sitting at 31st March 17. We say that we'll do an investment of 150,000 at 31st March 18. And for the next 7 years, we will get periodic cash flows like 20, 35, 45, etc. But then it is not like there could be cases in which we will not get any cash flow after 6 years, but there will always be cases in which we'll keep getting cash flow throughout the life of the machine, if this is a machine we are investing in. So we'll keep getting certain cash flows throughout the life of the machine. And in the beginning of the investment, the cash flows can vary. Like some year you'll get 20, some years you'll get 40. But eventually after 6 years, what happens is the cash flow becomes consistent. So this is what is terminal value in a way. We say that that this is the terminal value, and after the 6th year, our cash flow would grow at 5%, and it will carry on like this. Okay. So our terminal value is 66. because we've taken the growth rate at 5%, so our terminal, the cash flow is 69.3. What would be the net present value of this? So like this 69.3, for how many years would it carry on? Like what would be the total amount? To calculate that, we use this formula. So that is our terminal value. I'm just going to write it here. So our terminal value divided by discount rate minus the growth rate. So we come at 693. So basically what we're saying is that we invest 150. For the next 7 years, we get these certain cash flows. And then for the rest of the life, we get total 693 cash inflow. So now our total present value would be 130. And then these every year discounted at 15%, and the terminal value is also discounted at this, the previous years, like the last year's discounting factor. So now we have that our net present value is 231.2. So we've calculated whatever we needed to. We've calculated our terminal growth rate, discount rate, NPV. Now we want to see that if we keep changing one thing, how will our NPV change? So there are two type of data tables. There is one-way data table, row and column, and there is two-way data table, which is like this. Like there can be two variables basically. Then any like before we start this, any questions on terminal value or like how these numbers were calculated, and then we'll do the data table.
No.
Okay. So for the data table, so in this case, like, okay, let's do the one-way table first, and then we'll do the two-way data table. In this case, what we want to see is that if our growth rate keeps changing, what would be our NPV and what would be our terminal value? So here we have a growth rate as 5%. And we want to say that if the growth rate is 3% or 4%, 5, 6, 7, certain, we put this here. So what would be our terminal value and NPV then? So I'm going to copy this here to show something. Okay. So the first thing which we have to keep in mind for the data table is that we cannot copy paste the NPV and terminal value. It always has to be linked to the main table. So suppose if I had done give me a minute, guys. Yep. Hi. There was something wrong with my system. So, yeah. Okay. So we were doing the data tables. Just to show how this works, I'm just going to copy this bit here and do this again. If I delete this. So now what I want is at different growth rates and at different discount rates, I want this particular data table to calculate my net present value. So I have plotted, the first thing you have to do is you have to plot the variable amount like growth rates and discount rates. And I am just going to do this. And then you have to go to data, what if analysis. And then in that you have to do data table. And so what do you have to select in row input and column input? So your row input is growth rate and discount rate. So D8 is your row input, which is your growth rate, and discount rate will go into column input, which is B9. So when I do equal to, see what it does. It gives me 231.2 everywhere. So means something is not working, right? So what I'd done was I'd done paste special to this. So for the data table to work, you always have to link the value which you want to be calculated to your main calculation table. So if I link it here, then automatically it gives me the values here. Correct? Is there any confusion here? In data
Yes,
table,
ma'am.
like how? Yes, please tell me.
How we link to this main table?
How did we link it to the main table? So
Yeah.
the variable which we want to calculate, like in this case, what do we want to calculate? We want to calculate the net present value. Like how does our net present value change in case we change our growth rate and in case we change our discount rates, right?
Okay.
So this is our net present value here. So in the main table, we've calculated one net present value, which is at a growth rate of 15% and a discount rate of growth rate of 5 and a discount rate of 15%, right? So now if we want to calculate if these two numbers keep changing, how will our number keep the net present value number change? So in that case, what I was trying to show you was like you plot in your variables here. Fine. This is what you want, that your different growth rates and your different discount rates. I'm going to make this empty. Now what you do is, suppose like you see that you've already calculated 231.2. Instead of linking it to the main table, you just write 231.2 here. So then what the data table does is, because you have not linked this data table to anywhere in the main table, so it will just give the same NPV at all the scenarios. Okay. The moment you put a link like this, so basically now it links to your main table and it calculates according to your main table, and then it gives you different NPV. So what we are saying here is that like at 5 and 15% growth rate and discount rate respectively, we would get a NPV of 231.2. Similarly, if our growth rate was 3% and discount rate was 13%, our NPV would be 270.6. So we get our NPV in all scenarios, and you can see like at 5 and 15% here, you get an NPV of 231.2, which is exactly what you calculated here.
Okay.
Yeah. So you don't have to keep doing this entire calculation again. You can just do the simulation using data tables.
Okay.
Now, if this is clear, I will give you guys around 10 minutes. Can you like do one-way data table? I want you to calculate the net present value and terminal value at these growth rates, and net present value and terminal value at these discount rates.
Okay, we'll try.
Okay. I'm showing you this. I'm not sure. Do you guys have this Excel sheet?
No, we don't have.
Okay. So I'm showing you this. You can quickly note down these numbers and then calculate this. So you just need to note down this bit of the table. Have you noted this down? So I'll scroll down to the variable part. Okay. Yep. You need to calculate these two. The growth rate variable and discount rate variable into two different data tables. You can put any assumption for growth rate or discount rate as you want. It's just that your NPV and terminal value should come here.
Ma'am, please show the values.
Okay. Done?
It's done, but something.
What is not coming?
It's something 9.46. Very strange answer.
So did you make this table? Did you get the growth rate variable? So where are you getting 9.6?
The first table, I just calculating the total. Yeah, this is equal
Okay.
that. I'm calculating 252 something. What is this figure?
This 231.2.
Yeah, that's figure.
Oh, you're not getting this. Where is it not matching?
I'm not
So
getting
can
actually. Right.
like, are you getting these figures? 130, 15, 23, etc. All these.
No, not that. Actually, that's. I think there's something is missing. I'm just. Give me a minute. I will just try again.
Sure.
Hello.
Yes.
Can you put a cursor on present value? How you have calculated 130? Yeah.
1 minute. Present value is basically the cash outflow or inflow into the discounting factor.
Okay, so it's C5. C5 is cash flow. Okay. And oh, okay. Thank you. I'm just trying into. So it's
Have everyone got 231.2 here?
No, ma'am. Can you please help me to find out the discounting factor again?
Okay, so the discounting factor is 1 divided by 1 plus discount rate. This is the apostrophe like that. You can find that on 6, above 6 on your keyboard, and then C10. So basically raised to the number of year.
Okay.
So
1 divided
discounting,
by, okay.
yeah, 1 divided by 1 plus 15% raised to the number of year, as in it is discounted, like suppose if it is the second year, then 15% raised to 2 or raised to 3, like that.
Okay. Divided.
and the formula of net present value will be what we have
Net
to
present
consider.
value will be the sum total of all these values.
Okay.
So it's just the sum total.
Sum total only, no? Then
Yeah.
it's coming. Because I was,
Is 231.2?
yeah, I was considering this discount rate again and again, so I was confused.
Okay. No. So if you wanted to calculate using this net present value, we
Yeah,
had
I was
calculated.
using NPS formula,
Yeah.
right?
Okay, so you
Yeah.
don't really do these things there. Plus here we cannot calculate the NPV formula like that because we also have the terminal value here. So you could have used the NPV formula for this bit, but
Yes,
not
yes.
this bit. Yeah.
Okay.
So yeah. Everybody is here at 231.2 now. So now can
Yeah, it's
yeah,
coming.
the net present value and terminal value at different growth rates using the what if analysis, the data table, and similarly at different discount rates. So can you do these two tables quickly?
Okay, so it's 3%.
Done? Are we getting the NPV and terminal value? Can we move ahead if everybody is comfortable with this?
Yes, from my side, yes.
You've got the NPV and terminal value.
No, I will calculate after getting this sheet because I have to do much link.
Fine. Just keep in mind that you have to link these two things to the main table. And in the two-way data table, when we did data table, we put the row input cell and column input cell. In this case, when we select, we only put the row or column accordingly. Like here we have the row. The row will put the growth rate because our variable is growth rate. So we get.
Okay. So, ma'am, this is something other than this calculation. Why do we calculate this? That is the main factor. Means go on.
Why do we calculate the terminal value?
Yeah.
So, okay. So suppose if
so
you want
if the basic will be clear now, so that we can use our mind कि हाँ इसके लिए calculate कर रहे थे तो ये चीज आना चाहिए, right?
Okay, so why are you calculating the net present value and terminal value? So the terminal value you are calculating basically to estimate that if you invest, let's say that if you are in a manufacturing company and you are investing in a machine, so before investing into any sort of project or machine, you want to see that what result would you get out of that machine, right? So to see if that investment will be profitable, not profitable. How do you see that? Suppose if you are investing 150,000 against that 150,000, how much cash would you generate year over year? Now, when you are sitting in this year, like today, and you are going to invest in the next year, and your cash flows would come in the future years, what would be the value of those amounts at today's rate? Because in different years, the value of money is always different depending upon discounting rate. So when you want to compare apples to apples, so you bring down all the value of the money at today's rate to make a decision whether the net present value is a positive number or a negative number, and should you invest or not. So now this particular bit, so here we are doing this two-way data table and one-way data table to understand NPV and terminal value. You could use these data tables for any sort of simulation. What it helps us in is that we don't have to keep calculating these values again and again. We just have to make one master table where we have calculated the values once, and we keep changing our variables and our result would be there. So basically, our plot table is used only for and terminal value. It can be used in any scenario where you want to do a what if analysis. What happens? What if my payment terms change for the debtors? Then what happens? So for any simulation, you can use this table.
Okay.
Okay, so now we move on to the timing flags. Now, what are flags? It basically gives us sort of a hint, like a right or wrong. Like suppose if you want to see, like suppose we have to give the forecast for 10 years, and maybe that we start our production, or we start sales for our company in year 1, then year 2, year 3 we have sales. Due to certain circumstances, year 4 there is no sale, or year 5 there is no sale. So like we know all these assumptions before making the financial model, but when we are making the financial model, this thing should be clear at the top of our head that this is the case. So now that's why we flag the numbers. Like suppose we are sitting at 2017 and we want to always keep a check on when do we start our sale. So suppose if we start our sale in 2018, then we can flag it as 1, like this is the year where we start our sale. Now, instead of doing it manually, because now why are we trying to do all these things in formulas? So what happens in a financial model, mostly financial modeling is done for the future years. So there is a lot of assumptions, and depending on the time you taking to do the model, and you might revise the model again, you need to keep certain assumptions, and those assumptions should be flexible to change. Now going right back to our first example, suppose we have calculated the gap of 12 months. Now, when we are redoing the model and when we are going through the model again, suddenly we decide that we don't want 12 months, we want 10 months. So instead of calculating each date separately, we just change this one particular assumption and everything else gets changed accordingly. That's why we use a mix of all these formulas to make the financial model. So now flags is also like that. Like suppose if we say that our revenue starts coming from 31st March 18. Later in the assumption, we would say that no, it does not start coming from 31st March 18. It might start coming from 31st March 2017 itself. So now, instead of doing the flags manually, and instead of going and calculating and changing all your formulas, like your entire P&L will change based on that. So we flag it accordingly, so that at any time if we want to change our flag, the rest of our calculations flows accordingly. So flag is basically like a binary thing, 1, 0, yes, no, true, false. So anything like that. And the other thing is counter. So counter is 1, 2, 3. So basically this is a counter. Like this is our first, second year of inflow, third year of inflow. So this is a counter. It goes 1, 2, 3, 4, 5, 6, 7, 8. Flag is 1 or 0. Like either it is on or it is off. Counter is in continuance, like 1, 2, 3, 4, 5, 6. Okay. So very simple flag example. Suppose we have these numbers, and you want to see which of these numbers are bigger than 14 or bigger than 15 or anything. So now let's say if we were doing it manually, okay. So we wanted to check which of these numbers are bigger than 14. If we wanted to do it manually, we would have seen 5, no, 17, yes, 15, yes, and these would be no. Now later on, if we wanted to see that, let's say that if we wanted to change these numbers, here 17 was to change to 11. Okay. So now we would have to go and change this manually. We would have to go and change this manually. So, and then later on, if we've not linked anything to the flag, we would have to go and change everything manually. Now, if we put a formula, it's very simple. As soon as we change 17 to 11, the flag goes off to 0. So it's 1, 0, 1, 0. So if it is not bigger than 14, it goes to 0. Similarly, at any point of time in the model, if we want to not look at that the number is greater than 14, if we change our assumption and we say if the number is greater than 5, so we don't have to change all these things manually. We just change one assumption. So this is the benefit of putting these formulas and calculating on the basis of these formulas. Now, flag is not a formula, it's not FLAG. We are using the if formula to flag this. So now what do? We put a formula everywhere that if 5 is greater than 14, then 1, else 0. So it's basically if B10, which is 5, is greater than 14, which is A11, then it is 1, else it is 0. Everybody is okay with the if formula, or should I explain the syntax for it? I'll just explain the syntax then. If says logical test, so our logical test here is 5 greater than 14 or not, or is 17 greater than 14? That is the logical test. Then we have to say value if true. So whatever your logical test is, if that is true, what to do? So here you want that if the value is true, it should display 1. If it is false, it should display 0. So you put 1 or 0. Similarly, when you're using if, you can put anything like this. So if 5 is greater than 14, in this case, we put 1, 0 because that is what is needed in a financial model. Any other place, if you wanted, you could have put if 5 is greater than 14, then display true. So you would just say, instead of 1, which you write here, you can write true in inverted commas. And every time when 5 is greater than 14, it will give you the result true. So here we get our flags. Similarly, what is a counter now? So now counter tells us that, cumulatively tell us how many times the numbers are greater than 14. Okay. So the first number, obviously here we are starting. So our starting point will always be 0. What we do is flag plus counter. We do flag plus counter, the flag plus preceding counter. So if our 5 is not greater than 14, here it is 0. So we are still at 0. As in we have not started with the numbers being greater than 14. Now we come here, it is 1. So that means that now this is the first number which is greater than 14. When we come at 11, 11 is lower than 14. So it is still 1. That means till 11, then again till 9, only one number is greater than 14. Then similarly, when we come to 15, this 1 changes to 2. So that means now when we are standing at 15, there are 2 numbers here which are greater than 14. And then that's how, so now we understand the example of flag and counter, right? So flag is either on or off, and counter is in continuance, how many years or how many times, like that. Okay. Can we quickly do this example together? So basically here in this example, we say our construction is starting at 15 July 2019 and our construction will end on 31st Jan 2023. We want these flags and counters. Can you put the formula for this? So we want a start flag. So basically we want that whenever our dates are beyond 15 July 2019, it should be a start flag. Then we want an end flag, that if it is less than 31st Jan 2020, basically in between, then it is like that year is the end flag. We want a construction on flag, like put a 1 in each year when our construction is going on. So can we do this bit? Just put the formula, just pick any 3 or 4 dates. You don't have to put the exact date, and just put the formula to see if you completely understand what the formula is doing. Are we good? I am assuming that we are okay with this. Since nobody has any questions. Okay.
17.
So this is what we have done manually. We had put a 1 on 31st.
Ma'am.
Yes. Yes.
how we calculated count. Go on
You
first.
counter this count.
This count. How we have calculated this?
So before that, like what is the count doing? It basically tells us that can you count? Can you show a cumulative count? As in, how many numbers are greater than 14 at any point? So that is what we want to calculate. So when we start, we obviously start with 0. Then we've just done, this is a cumulative, like, okay, let's do here. Suppose you have numbers like 1, 2, 3, 5. You want to see the cumulative sum. So what do? The first number would just be this. Then it would be this.
And plus this.
So here
yes.
it would be this plus this. Then it would be this plus this. Yeah. So what are you doing? You're taking the current number and adding up to the previous number, right? So that is a cumulative sum. Similarly, here we want a cumulative count. So our cumulative count is dependent on this this flag which we had plotted. So we always start with 0. Like here we see is 5 greater than 4. So here it was no. So that's why it still remains as 0. Then when we come here, that 17 was greater than 0. So there is the first number which is greater than 14. Sorry, the first number which is greater than 14 is 17. So here it was 1. So this is our count 1. So if at any point you see this, that means up till this point there is one number which is greater than 14. Again, 11 is 14, so our number still remains 1 because it is 1 plus 0. Then again it still remains at 1. But when you come at 15, our number becomes 1 plus 1, 2. So we are trying to say that up till this point, there are 2 numbers which are greater than 14. And this is how we end. So in this, we are saying that in this total array of numbers, there are 2 numbers which are greater than 14. Okay. So similarly, like this was a simple example how you use in your model. So if you want to see that if you're manufacturing or construction, what year of construction you are at or what year of manufacturing you are at. Is this the second year or third year or fourth year? That is when the count helps you. Flag tells you that your construction is on in this year or off in this year. Count tells you which year of construction you are at. Okay. So here, let's see. We wanted these flags. So this is the way we would have done manually. Start flag, we see 15 July 2019. So that falls in this year. So we just put 1 here. Then construction end date 31st Jan 2023. So we see that falls in this year. So we put a 1. In between these 2 years, our construction on flag is 1. And then when we talk about construction counter, so this is the first year, this is the second year, third year. So now if we don't want to do this manually because our exam, like suppose at any point in the model, we want to change this date. So we would have to change this we would have to come and change this manually, and all these lines we would have to change manually. So in case we don't want to do that, so we do it using a formula. Again, we use most of the if and or. These are the logic formulas which you use in these flags and counters. So what have we said? We are saying that if B23, which is our construction start date, is less than or equal to this date, then it is 1, else 0. Okay. So that's why we have 0, 0, 0 here. And we have 1 here because July 19 is less than 31st March 20. Right? We come here. Then construction end flag, we put a similar formula. We say that if B24, which is our construction end date, if it is greater than B40, but we also have to check that it is less than the previous year. So that it falls in between the 2 years. And then it is a 1, else it is a 0. So we get a construction end date here. Then the next formula, which is construction on flag. So basically, if these dates are between these 2 dates, so we put an and formula, then our construction is on, else it is off. So we get 1, 1, 1 here. And our construction counter is simple like we had done there, 0 plus 1, then 1 plus 1, three, like that. So this is our first, second, third, fourth year of construction. This might look like a very simple thing, but when we get on to do the financial modeling, you will see how it helps in the rest of the calculations. So now suppose if you calculate a revenue, so if we plot the units, we don't have to do manually. Like suppose we say that the rental, suppose we're calculating cost and we say that our rent increases 15% every year. So we can just put 15% here, fine. And we don't have to calculate like 15% into 1, into 2, into 3 manually, because you already have a counter. So you can link it like that. So it is 15% raised to 2 or 15% raised to 3, depending on your counter.
Okay.
This is what this example shows. So suppose you have, so this is your operation flag, this is your operation counter, and then the base year is 1st April 2019. We say that the base price is 3,500, and every 2 years the price escalates by 5%. So our escalation period is 2 years. So we put a escalation flag. So see this. So escalation flag is, if this is the first year, yeah, here it is 1, then every 2 years you get a flag, and then you can easily calculate the price. First year it would remain 3,500. Here there is no escalation because it would do 3,500 into 5% into 0, because our escalation flag is 0. So it remains as 3,500. And similarly, the escalated prices are calculated.
Yep.
Okay.
Yes, ma'am.
Let's take like a 15 minutes break, and then we'll carry on with the dead.
Okay.
Okay. So we're starting with our debt example, like how to calculate our payment amount and interest amounts for any debt, depending on like what is our method of repayment. Is it a certain percentage at a given time period or a lump sum payment? So depending on that, how to calculate our installment amount and interest amount, the principal and interest amount. So this is our example. All the assumptions have been given here. So years, our total debt is 1100 million. Then our drawdown schedule is we basically get 35% in the first year, then 35 in the second, and 30% in the third year. So by 2019, we've got our 100% of the loan. Our interest rate is 11%, but it says it is only applicable post full drawdown. So basically, we start paying interest from 31st March 20 on, as in the year 2020 onwards, after our full drawdown. So we'll calculate different repayment schedules. The first one is repayment schedule is manual. So a certain percentage is given, and based on that percentage, we just have to pay that much amount in the given year. Then it says repayment schedule bullet. So it says that repayment schedule bullet means that in the given year, you make like a lump sum amount, lump sum outstanding amount, you make a lump sum payment. Then the third one is repayment schedule equated principal. So basically, whatever is the number of years, like here it is 4, so you pay in those number of installments. Then the fourth one is repayment schedule EMI. EMI as in you pay in 3 EMIs. So yeah. Then we have a sculpted cash flow. So basically here in like here the percentages were given. Here the entire amount is given that you pay so and so. Then we have sculpted DSCR to be maintained. So that means we'll look at all of these one by one. So let's look at, we'll start from here. Okay. First, we'll calculate like whatever is the drawdown. So we'll get what do we need our debt schedule? We need our opening balance. We need how much are we getting, what loan amount are we getting in that year? Then what loan amount are we repaying in that year? So that will give us our closing balance for each year for the debt. And then we'll also calculate the applicable interest every year. So in the first year, which is the year ending March 2017, our opening balance is 0. What would be our first year drawdown? 1100 into 35%. So we've done that. There are repayment is 0 because we start repaying only after the full drawdown is done. That is in the third year. So repayment is 0, 0, and 0 here throughout. So the first year's closing balance is 385. The second year's opening balance, the opening balance is always linked to the previous year's closing balance. So the formula is just equal to closing balance of the previous year. Then our drawdown for the second year is again 35%, 1100 into 35%. There is no payment, so we come at closing balance. Similarly, third year we have the balance drawdown, which is 1100 into 30%. And then again, we have a closing balance. repayments. Now from the 4th year onwards, our drawdown is completed. We've got the entire loan. So our total loan, which is 1100 million, payment schedule manual. So here we've been given certain percentages, and our repayment amounts are all our repayments, and then on that, depending on whatever method we want, we've linked it here. So suppose if I change this to bullet, our repayment schedule changes accordingly, whatever we choose. So we have a drop down here, and then accordingly it will change. So let's do this one by one. First we'll see how is the manual method calculated. So now manual method, our repayments will always be 0 in the first year, first 3 years till our drawdown is completed. Then let's see from the 4th period. So 4th period, this thing, manual repayment is very simple, just the total amount of loan and then the percentages which have been given. So 1100 into 15%, then 1100 into 20%, and so on. And then since this percentage here is 100%, so by the end of 31st March 2025, we've repaid total 1100 million. To be noted is that we are only talking about like in each of these methods, except for the EMI method, we are only talking about the principal amounts and not the interest amounts which have to be repaid. So here, if you look at the manual method, we've repaid 1100 million. Now we go to the bullet method. So what is bullet method? Bullet method says that a lump sum amount has to be paid as on 31st March 2024. So now one way of doing this manually is you go to 31st March 2024 and you do minus 1100, as in you paid out your entire loan. The other way is to link it through formulas, so that in case that 31st March 2024 date gets changed, your repayment schedule will automatically adjust. So here we put this formula. What we say is, if C5 equals to B11, so what is a C? Basically this date is equal to this date, then you repay, like you do into 1100. If it is not, then it is 0. So this formula remains like this. Eventually, when 31st March 2024 is equal to this, then it is 1100, and rest of the columns then have 0. A third one is repayment schedule equated principles. So here we say that post the full drawdown, we pay the amount in 4 equal installments. Okay. So equated principles here. So now here is where we use the flagging method. Like we will see that when does our drawdown end and what are the 4 years after the drawdown, and we flag them as 1. So either we can only flag as 1 or 0. So basically the 4 years after the drawdown, we'll flag them as 1. So we put a formula here that if C93 is less than equal to B12, if C93 is less than equal to B12, so this is post drawdown counter. So our drawdown counter is 0 here. So if 4 is 0 is like less than equal to this, so then it gives you a 0. So basically this is our drawdown counter. So this is the first year after drawdown, second year after drawdown, third year and fourth year, so on. And based on this drawdown counter, the repayment flag is 1111 for the first 4 years. Okay, when we get the first 4 years, then we calculate what would be the equal installment, which will be 1100 million divided by 4. So we've got that. Now, how do we distribute this 275 million in the 4 years where it should actually go? So what do? Is we take 275 and then we multiply it with the flag. Now, what is the benefit in doing this? So we have 275 million here. Now, there could be a question that why couldn't we just do 1100 divided by 275 and just put in these? Why did we have to do a flagging and then we had to calculate it like this? So let's say that like if our assumption changes and then we say that we instead want to pay this by 2023. So then we don't have to go and do this manually. Automatically it shifts to these 4 years. So whether, depending on what date you put here, this payment will automatically shift accordingly, depending on the number of installments you put here. So if you want to change this to 5, so if you come here, see the flag has been changed to these 5 years. And so has the amount changed to 220 over 5 years. So this is the benefit of putting in the formulas and then putting flags like that and calculating it based on 1, 0, true, false flag. Now, the next one is EMI structure. So basically in case of EMI, we're talking about principal plus interest component, and it says that you have to pay in 3 equal EMIs. So you've calculated your EMI flag accordingly. That is 3 years after the post drawdown, and now you have to calculate the amount. So the EMI you calculate by using 2 formulas. There are 2 formulas in Excel. One is PPMT, the other one is IPMT. As it says PPMT, it says rate per N per, then PV, and then obviously we are not paying anything, then it is just 0. If not, then calculate the principal amount. So it says PPMT B8. So B8 will obviously be our interest amount because the syntax was rate. Okay, so B8 is our rate, which is here 11%. So we do that. Then it says per, this is F93, this as in which year of the repayment are we in. So that comes to the first year. Then we say, let's go here. Then we say that in how many installments do we have to pay? So we say 3. So that is N per. And post that we say that what is the total amount we have to pay, which is 1100. Okay. So B6 and then 0. So what all does it need? It basically needs the rate. Which year of repayment are you calculating for? How many installments do you have to pay? And what is the total loan amount? So total loan amount will remain the same for all the years. So our B6 is frozen. Total number of installments will also remain same. So B13 is frozen and our principal amount to be repaid. Similarly, IPMT uses the same flag, same prompts. So which is rate, which is the year of payment, the number of installments and total loan, but it calculates the interest portion of the payment. So that is calculated and thus we get a total amount. And and this is our total and this matches with 450.1. Here's our total. The last one is sculpted repayments. Sculpted repayments, it tells us that we want to maintain our debt service coverage ratio as 1.1 and then we decide the principal payment accordingly. So our scheduled repayment cash flow is these amounts 250, 400, 630, etc. over the years. And let's see how we do the debt service coverage ratio. So we have we've taken the debt service coverage ratio as 1.1, and then we see that how much can we repay depending on our debt service coverage ratio. We've calculated that, and thus we calculate our principal repayment amount, that is it comes to this bit. So 1.1 million, depending on our debt service coverage ratio here. So these are the four methods of repayment. Not all methods will be used together, but this is just to explain how you use the formula PPMT, IPMT, and also how you use flags and counters in a financial modeling. One of the examples is while using the loan repayment profile, while making the repayment profile, but it could also be in different scenarios. I'll just let this be here for 2 minutes. You can look at this and you'll obviously get this Excel sheet. So when you do it yourself, it will be more clear. But yeah, I'll just let you look at these numbers for a bit so that if there is any issue. Okay. The last formula which we are looking at is offset formula. So what offset formula does is it returns the reference from a given number of rows and columns. So it basically, like if you say, if you want the number to be picked from the 2 columns before the particular cell or 2 rows before a particular cell, so it helps you pick that number instead of doing it manually. So let's see the difference in without using offset and with using offset. This is very useful for calculating our receivable balance and our payable balance, because generally the terms are that our debtors would pay us in 2 months or 3 months. So we can, like, while calculating how much would the payment be coming in this month or this year, we can basically do, like, suppose if it is coming, if we have given them a credit period of 2 months. So in the 3rd month, we can pick 2 columns before what was the amount we had sold, and then accordingly we can put that data as the payment of that month. So that helps, like the offset formula helps us in doing that and calculating our collections and balances of receivables and payables. So without using the offset formula, let's see how we would have calculated our balance of receivables, and then we'll use the offset formula for the same. So these are our so our opening balance is the first year sales is 250 million. So our receivable in the first year is 250 million. Then and here we say that the collection of receivables is with a 2-quarter lag. And these are our quarterly sales numbers mentioned here. So the first quarter obviously is the first quarter, so there is no collection. So our closing balance is also 250 million. Opening balance 250, we sell 286. Now, since there were 2 quarter lags in the second year also, there'll be no collection received. Now, the third year, we know that whatever we sold in the first quarter would be received in the third quarter, because now 2 quarters have gone by. So we've done this manually. We've linked this to 250 million. Similarly, we've linked these numbers manually, and that's how we've come to our closing balances. Now, instead of linking this manually, if we wanted the offset formula to pick this 250 million on its own, how would we do that? Come here. So now opening balances, we have put that the collection during the quarter, there's a 2 quarters lag. And that's why for the first 2 quarters, the collection would be 0, which we have put here. So now this will remain the same. Opening balance is linked to the previous quarter's closing balances. Receivable during the quarter is our sales, which is given above. So this is also going to remain the same. The change is going to come here. So which is collection during the quarter. So now what we say is, we say offset D16. Okay, let's look at the syntax first of offset. It says the reference, that is which column or row do you want to start counting from. So that is our reference. Rows, as in how many rows do you want to count, go back to or go forward to. Columns, how many columns do you want to go back to or forward to. And height and width says number of rows and columns which you are going to pick. So if you put 1, 1, that means only 1 column or 1 row. If you put 2, it is going to sum total 2 columns or 2 rows depending on what you're putting. So let's see what it says here. So it says offset, and we put a minus formula because we have to subtract from the above balance. So we say offset D16. So this is a reference cell, that is D16. So we want to start counting from D16 in this case. Then it says 0. So that means number of rows which you go above or below is 0, because we don't have to go above or below like this. We have to move columns here. Then it says number of columns which you put is B17. So you put a minus B17 because you have to go towards the left. So it says minus 2. So you go 2 columns towards the left and you pick the amount. Then it says height and width is 1 and 1. So that means that you only pick 1 column, you don't sum total, and you only pick 1 row like that. So if this is our reference cell 250, you go 2 columns back, you come to 0, and that's why you have a 0 amount. You pull this formula here, you are here, then you go 2 columns back and you get a 0 again. Then you are in the third quarter, you go 2 columns back and you get 250, because height and width is 1, you pick 250, and that's why you've got a 250 million here. And this is our closing balance. Any doubts here on the offset formula?
No, ma'am.
Okay. Now, there are a lot of ways you can use a variation. In this example, like we know there has to be 2, like there is 2 quarters lag. In case in case your model was more complex, and it would have said that take 2 quarters lag or 1 quarter lag or 3 quarter lag, whichever is lower or whichever is a higher number. So in that case, we combine the offset formula with other formulas like minimum or maximum. So depending on the case, you can do that. So here it is combined with the minimum formula. So as in, you go back those many quarters, either 2 or 1, whichever is minimum, either 2 or 2 minimum, like 3 or 2, whichever is minimum. So like that. there can be a lot of variations, and you can just combine it with the offset formula. Now, if you wanted a rolling sum or average, like you wanted to combine 2 rows or 3 rows or columns together, that's when you increase your height and width in the offset formula. So let's look at this. These are our periods. It says that calculate the rolling sum and average of above annual sales for a dynamic range. So these are our sales. This is a period. If we were doing it like suppose you want to calculate the sum of three periods together always. Okay. So it says sum of offset D32. So this is our reference cell. Then it says that 00, as in you are not going back any column or row, you are here only. And then it says how many do you want to count, like how many periods do you want to club together. So it says height is 1, width is minimum of D36 and D35, that is 3 and 1, so it's 1. So now it will give you 50 because you are here and it is telling you the width is also 1. Now let's say when you go to the second period, again it says that you are 100. 00 means that you are not going back any row or column and not going forward either. Then it says height is 1. So that means like column wise, the height is just this one particular cell. Row width is minimum of D36 and E35. So that is 3 and 2. Minimum is 2. And it is minus minimum. So it goes back one cell. And then our cumulative sales number comes up to 150. Similarly, it goes back 3 cells here and our number comes up to 225. When we come to the fourth period, because we are doing a minimum, this is how we use offset and minimum together. So because we only want 3 rolling sums, we don't want more than 3. So minimum is 3, out of 3 and 4, minimum is 3. So it will only go back 2 cells and it will give us the sum of 3 periods. It will not do like a total cumulative. So it gives us 300, which is just these 3 periods and not the entire period. If you had not used the minimum balance, then it would keep rolling and it would give us the total sum. So this is that. And similarly, you want like the average of 4 periods. So instead of like you use a minimum function again, but instead of 3, you put a 4 here and then you use offset in a similar manner. So accordingly, with the offset function, you can calculate the depreciation of the asset. You can similarly prepare the asset schedule, and you can use this in various functions. Just have to remember that the idea of the offset formula is that it will move back or front depending on how much ever you tell it, 1 or 2 column or row, and it will either give you that particular cell or the sum of a few cells depending on the height and width. Is that okay? So any confusion in any of these formulas which we've done right now? Okay, I'll take that as a no then, that everything is clear.
Hello.
Yes. Yep.
So this map. Okay. So these are for practice. What is this? The screen.
This is a case study which you will be doing. I'll be walking you through this case study in this session, and then we'll be covering the solution of the case study in another session. But you will have to basically do a financial modeling, which I'll walk you through, that what is required, and you have to do it on your own, and then we'll walk through the solution in the next session.
Okay.
Yeah. Is there any question on the formulas we've discussed?
No, ma'am.
Okay. So, so basically, we have a case study right now, and then you would have to make a financial model, basically a P&L statement, balance sheet, and cash flow based on the assumptions and the guidelines given in this case study. This case study will be available with you on the Maticus website. You can pick from there, and then in the next session, we'll be discussing the solutions. The idea is that you do the case study on your own, and then we'll go through the solution. So this case study is about a company called Western Printers Limited, and the Western Printers Limited, they're going to start a business, and to commence the business, they have infused a certain amount of equity on their own, but they also want a loan from the bank. And to get the loan from the bank wants to see a 5-yearly plan of their P&L, balance sheet, and cash flow, so that to base as the basis of the loan. And for that, now you have to prepare the financial model for Western Printers Limited. So let's read through this. It says that you are setting up a company called Western Printers Limited and are expecting to commence business on 1st December 2017. So mid-year, you are commencing business 1st December 2017. Then it will be a Mumbai-based company engaged in trading of printers. You've identified a Pune-based manufacturer to purchase printers from and intend to sell the printers in Mumbai, earning a margin over the cost. Okay. WPL will have no other. Just going to. Yeah. So WPL will have no other lines of business, and earnings from printer sales will be its only revenue stream. So it's a Mumbai-based company. The manufacturer of its printers is in Pune, and its only line of revenue is from the sale of printers. There is no other revenue. Okay. Then you've identified a medium-sized store for rent at Lamington Road in Mumbai, which is a hub for computer accessories. This space is already available to you since 1st April 2017. So basically, you will be giving out rental from 1st April 2017, that is for the full year of 17-18, but you are only expecting to commence business on 1st December 2017. Now, between 1st April 17 and December 17, you will have to incur some renovation and refurbishment cost to make the store ready for operations. Now, you'll also have to incur some maintenance expense every 2 years. Now you plan to work as the store manager and will take home a salary equivalent to the average salary you plan to offer to the employees. In addition, you plan to employ a deputy store manager and 8 other sales staff. So how many people would be there? The owner himself as the store manager, then a deputy store manager, and then there'll be 8 other staff. So there are 9 people working. So salary to 9 people. You've calculated that apart from this, the only other fixed cost for WPL will be on account of housekeeping charges and expenses for utilities like electricity, water, light refurbishment, refreshments, etc. Okay. So now these are our expenses. Now we'll read about what are our inventory terms and debit period and credit period. So now, based on your discussion with your supplier, you've noted down the following terms. You will receive printer stock on the 3rd working day of every month at an all-inclusive price, which includes transportation cost of the inventory from Pune to Mumbai. So on your raw material, you do not have to incur any other cost. The cost which you are paying to your supplier, that includes everything, all insurance, everything till your warehouse. You do not plan to offer much credit to your customers since most of your clientele is likely to belong to the retail or small offices segment, and payment will be on delivery of the product. Accordingly, your supplier has agreed to offer a credit period of 45 days and you will maintain at least 1 month worth of inventory at the godown forming part of your premises. So there is 1 month inventory, 45 days credit period, and the customer period is, it just says that it is not much. We'll see further that what is that not much, how many days. Now, as part of your inheritance, you have a parcel of land in your village, which is worth 7 million. You intend to show this as an asset on your books, but it does not contribute to your operations in any manner. You plan to capitalize and consider depreciation as per the written down value method on your renovation or refurbishment expenses, as well as the maintenance expenditures which you will be incurring going forward. Which is like, it says that it will have to incur maintenance expense every 2 years. So that expense will be capitalized every 2 years. Now, based on a rough calculation of all your savings and funds available to you, you have estimated that you will be able to fuse approximately 10 million to start the business. So that's our equity. Now, you've spoken with some of your banker friends and concluded that you will be able to secure debt funding of 5 million to help you with your initial cash flow pressure. So equity is 10 million, asking for a loan of 5 million. However, the bankers will ask you for a detailed business plan in order to sanction the funding. Okay. So now you are required to set up a model showing the business plan for WPL with its cash flow for the next 5 years, including a 3-way integrated financial statements, which is P&L, balance sheet, and cash flow. Any questions so far?
No, nothing.
Okay. So now let's see the detailed guidelines. Following are the points which need to be considered. So these are the guidelines. Guidelines are right from what color your cell should be, what should be the width of your cell, what should be the font of your data, what should be the alignment of your data, everything. Because a financial model basically has a lot of numbers, and for a third person to easily read through it, you need that everything should be formatted in such a way that when you look at the financial model, you know that this is an output cell, this is an input cell, or this is an assumption cell, this is a variable. So because for that, we have all the cell formats given, and you need to keep the cell color, font, alignment, etc. of your model according to the guidelines here. So it says that set your column widths as given in table 1A in the model guideline sheet. So this is this. So when you are making your model, your column A will be 3, width of 3, then B will be 4. So accordingly, the width is given. You need to set your column widths according to this. Then cell formats to be used, that is using cell styles in Excel, the range name, model timelines, etc. They are all here in 2A, 2B, and 2C. So our model timeline is that model start date is 1st July 2017. Timeline, you have to make it for 5 years. I think this should be 1st April 2017. Then model timeline is 5. Start date is first Jan 2018. First. Was December 2017. Then your range name, your millions, crores, etc., monthly, quarter, everything is given. Let's go through one of the formats. So any input, general, like any input cell would be center alignment vertically and horizontally. So this is the center alignment horizontally and center alignment vertically. So I'm just going to do this. Font should be Arial like this. The font size will be regular, and then font style, this will be 10. And our font color would be RGB 017680 specifically, and this will be the fill color, and our border style will be dotted. So we need to follow these guidelines for every cell, like input cell or any output cell. Output style is here. Then if we have an in sheet reference, that color would be different. If we have an off sheet reference, that color would be different. So basically we need to follow all these guidelines for the financial model. Now the third part is consider annual timeline for the model. That means your financial years would be April 17 to March 18. So then you have to keep in mind that our first period will be April 17 to March 18, but our revenue for the first period will only be for 4 months because our operations only start from December 17 to March 18. So in this is one of the places where the flag comes into help. So you can use the flag and counter to make this then. Then you have to set up a check sheet and set the error tolerance as 0.1. So basically, if there is any variation between the balance sheet numbers, asset side, liability side, etc., so the error tolerance is only 0.1, not more than that. So you have to set up a check sheet which says that any of the numbers, if the variation is more than 0.1, then it tells you check, and then you know that there is something wrong in the model and you need to go and check your model again, something is not right. Then set up the revenue inputs as per table in section 3A. So you come to this 3A. So our revenue inputs are given, that what should be the price, what should be the quantity, and then it says that units sold in first 3 months. So price and quantity is given as per the first 3 months. Then it is also mentioned that what will be the escalation, that is 5%. Our quantity would also increase by 5% per annum, and our price would also increase by 5% per annum. Now in this you would need to take care of the fact that price, yes, it can increase 5% on the base price, but quantity, the first year's quantity is only for the first 4 months, that is December to March, and the escalation would be 5%. So you can't do 1500 into 5% escalation because this is only for 3 months. So you would have to calculate the comparative, the proportional full year number for the first year, and then that you will have to increase 5% per annum. Next, set up the cost related inputs as per section 3B. So our fixed cost, variable cost, everything is mentioned here. So in fixed cost, we have a rent, personnel cost, and other fixed cost. Rent is of the warehouse the WPL is taking on rent. It says that our rent is 1.5 million, and then there is 5% increase every 3 years. So again, you will need to use flag here, because you will have to flag if this is the 3rd year or not, and then accordingly you can calculate the escalation. Then personnel cost is 10 million, and there is a 5% increase year over year. Then there is other fixed cost, which it was talking about utilities and housekeeping, etc. That is expected to be 1.2 million, and that will also increase by 5% every year. Now talking about the variable cost, there is cost of goods sold, marketing cost, and other variable cost. So cost of goods sold, it's again, this is all for the first year which is given. Cost of goods sold, it says that it is 17,000 and it will increase by 5% every year. Similarly, marketing cost, it is given in terms of percentage. It says that it is 5% of the revenue of that particular period. So 5% of the revenue per period. So there is no escalation to be mentioned here as such. If our revenue increases, our marketing and other variable costs will increase. If our revenue remains the same, the cost will remain the same. So it's basically a percentage of the revenue cost. Okay. The next input section you'll be setting up is fixed assets. You will find the details for this in 3C. At 3C, you have to set up a fixed asset. What all is there in the fixed asset? There is land on which there will be no depreciation. So depreciation rate is 0%, and the value of land as mentioned here is 7 million. Then there is Kpmg. So what goes in the Kpmg? All the refurbishment expense would actually go into the Kpmg, and that is 4 million, and it has to be depreciated by 15% per annum on a written down value method. Maintenance Kpmg, this is every 2 years the maintenance expense which WPL would be incurring, that would be capitalized, and that will also be depreciated by 15%. It also says that the base cost of maintenance expenditure is 1.5 million, and this is expected to escalate by 5% per annum. Okay. Then our next point is set up the inputs for capital structure. So we know that equity capital is 10 million, our debt is 5 million, and our debt to capital ratio would remain as 33.3%. Then it is giving us our debt repayment, like the interest rate and debt repayment period. It says that we have a moratorium period of 2 years. So basically for 2 years, we will not be paying anything. After 2 years, we'll start paying the interest. Then number of equal annual repayment installment is 3. So when we get the debt in the first year, 2 years, we don't pay anything. After 2 years, in 3 equal installments, we pay the principal amount, and interest. On top of that, our interest would be 11% of the closing balance. So on the average balance. So it says that interest is to be computed and paid on average debt during the year. So you would basically have to make a debt schedule like we had seen in the example. You would have to calculate the opening debt, the closing opening debt, any loan which you have taken during the year, any repayment, and then you come at the closing debt, and then on the average opening plus closing divided by 2 would be your average balance on which you would be paying out the interest. The next one is set up the working capital related inputs. So working capital is our inventory, debtors, and creditors. So we've already seen that like in the case study, it says that the inventory would be 30 days of variable cost. Creditors would be 45 days of all operating expense, and debtors is only 15 days of the sales. So when you calculate this, just be mindful that in the guideline, 30 days of what do you have to calculate? So inventory is on variable, debtors is on sales, and creditors is on all the operating expenses. Then it says that set up the tax related. Our tax is 34.6%. And then once you are done with setting up inputs, set up calculation for each item. So you need to have like one assumption sheet, then you would have one calculation sheet. So it's not like straight away you would start drawing a P&L and then you'll do all the calculation in the P&L itself. You don't have to do it like that. You just have to have two, three different sheets. One would be our assumption and input sheets. One would be a calculation sheet. And then eventually the financial statements, which will be linked to the calculation and assumption sheet. Then it says, then go about preparing your financial statements, that is P&L, balance sheet, and cash flow. Then check that your model is working fine by getting up appropriate checks. So wherever necessary, put checks like suppose your model, the cash flow is in negative number, it is less than 0, or you want to put that your cash flow is less than 100,000, whatever it looks good to you, like whatever you think that there should be a check for, put checks accordingly in the model so that you can be sure that it's an accurate financial model. Because obviously, if we have a negative cash flow, the bank will not give us a loan, because that would mean that we won't be able to pay back the loan to the bank. So we need to be sure about these things, that our cash flow is positive, our balance sheet asset side is matching the liability side, etc. So put these appropriate checks wherever it is required in the model according to you. So yes, this is the case study which you have to do. And any questions here?
How to start? Matlab, first we have to make balance sheet and then go to.
So, you don't have to start with the financial statements directly. This point, it says that once you are done with setting up inputs, first step is setting up inputs. So what all do you set up in inputs? All these guidelines which is mentioned here. So you set up the flags, when is an operation starting, how many years, like what is the operation counter, like first year, second year, third year, which we had done there in the formulas when we were seeing. Then accordingly, like what is, like you need to set all these inputs, like what is the price, what is the quantity, etc., all as per the guidelines. Then the second sheet will be, so you are done setting up the input. So in the inputs, you also have to take care of all these things, and what is the format of the cell, etc. So you have to set all these things up. Then you go to a calculation sheet. So in the calculation sheet, you should calculate everything for 5 years, right? From the beginning, like you'll have to calculate what would be your revenue. So it's not like, suppose you are doing the P&L and you come to revenue minus cost of goods sold, and you get like what is your gross profit, then expenses, etc., and you get your net profit. So you don't calculate everything in the P&L itself. Every line of the P&L or every line of the balance sheet, you have to calculate separately in the calculation sheet, so that it is all very clear. Then eventually you will go to, after the calculation sheet, you will make the P&L and balance sheet, and you will, in that P&L and balance sheet, to the maximum possible, you are not going to use calculations as such, you are going to link it to your calculation sheet. So for example, suppose you have to put the revenue numbers in your P&L. You should not be calculating the revenue in the P&L. You should be able to link those lines to your calculation sheet, and your calculation sheet should already have a calculated revenue number. Yeah, does that make sense?
Okay. Okay, ma'am. I will try to do that. But I am not sure that I will be able to make it or not.
That's okay. We'll anyways be going to the solution in the next session, but it is beneficial, like at least try and doing whatever you can, because when you get the flow of all the formulas, at least whatever we had done in these, we had like practice each of these formulas as well for the comfort of books, and then try and using all these formulas in your financial model wherever possible.
So basically, I have to make a sheet where I have to enter all the this numbers, right, as per guidelines.
Yeah, as per the guideline, you have to make an income statement, balance sheet, and cash flow.
Okay. Okay, I'll try to.
Okay. Any other questions, anybody?
So, can I ask a personal question? You are from Mumbai or you are from Delhi?
I'm from Kpmg Gurgaon. Yeah.
Okay. So, ma'am,
Yeah.
can you come to the class, because financial modeling online classes means I'm not able to understand, and all my batchmates are silent. So,
So the thing is that you'll get all these study materials from Ematicus website, and about the class, it is that is what we've agreed with Ematicus due to the COVID situation. Otherwise, we used to have offline classes.
Okay. 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 Thank you.
Okay. If there are no more questions, we'll wrap this up, and then we'll discuss the solution in the next session.
From my side, it's okay. Thank you, ma'am.
Okay, thank you.